Hello, welcome back to Chapter 2 of the Osborne Books AAT Bookkeeping Controls book. I'm going to take you through that now. It's payments methods and the bank account balance. What this is going to do is it's going to go through how payment methods impact on the bank account balance, really. And it's sort of setting up in Chapter 3 the bank reconciliation, where you're going to reconcile between the cash book within your own ledgers to the bank statement that's coming in. And I'll take you through that in the next chapter. But in this one, I'm going to go through Chapter 2. So first of all, it sort of starts off and it just gives you a bit of a sort of a statement about, well, the current account, which is the account that you've got within your bank, which the business has got, that it's going to pay money into and have payments made from. And then it's got this idea of debits and credits. Now, if you have within your own cash book, within your ledgers, the company's ledgers, an asset would be a positive balance, wouldn't it? It'd be a debit. You know, so if I've got positive cash book, positive cash in my cash book, it's an asset, and therefore it would be a debit balance. If I had a negative balance within my cash book, it would be a liability, and it would be a credit. So that would be what you would see in your own double entry bookkeeping if you were setting out your cash book within your accounts. Now, what it highlights here is that actually, if you looked at the bank statement, it would look the opposite way round. If you saw a negative balance, a debit within the bank statement, that would actually be a negative balance. It would be a liability. And if you saw a credit on the bank statement, that would be a positive balance, and that would be an asset. And you can see, and I've sort of laid it out here, that they are the opposite way round to what you would see. The debits and credits, the opposite to what you would see in your cash book. And well, why is that? Is the bank just trying to be annoying here? And well, the thing that you've got to just straight up get in your head is that your cash book in your ledgers that you prepared and your double entry bookkeeping is for your company. So that's you, that's your company. The bank statement is the bank's cash book, effectively, and so it's from the bank's perspective. It's not from yours. So if you have a positive amount, a debit balance within your cash book, well, that will be a credit balance within the bank's statement, because that's they owe you money. If you have a credit balance within your cash book, you owe them money, so that will be a debit balance for them. So first things first, cash book is from you, that's yours. Bank statement is the bank's, so it will always be the opposite. It will be the mirror of your cash book. Difficult concept to get around in your head. Important to understand though, because you need to have that for bank reconciliations. So just remember, the bank statement is from the bank's perspective. It's their position, so it'll be the opposite of yours. Okay, so that will be the first thing. Then you have another bit of terminology, which they have is something called an overdraft. And so an overdraft is where the business has a debit balance with the bank. Now, this could either be agreed or it could be not agreed. So let's say we're going to have a good position. We're going to agree this thing in advance. We're going to go along to the bank and we say, well, can we have an overdraft, please? £25,000. It says in the book here. We've agreed it for a particular period of time, so 12 months. And we've had this arrangement, and this allows us to go into these debit balances with the bank statement. Credit balances in our cash book. The opposite. Now, though, actually agreed in advance. And the reason why we're agreeing this in advance is because we think that our cash book is going to sort of swing backwards and forwards between debits and credits. Backwards and forwards between, we owe them sometimes they owe us. It's going to move backwards and forwards. It's not going to be stable on either side. There's not going to be always an asset for ourselves or always a liability for ourselves. Sometimes they're going to move backwards and forwards. Now, the reason why this is important, that actually it will swing backwards and forwards between these debits and credits, is that if it was always going to be on one side or the other, so it was always going to be a debit within our cash book or a credit within our cash book, well, we would choose a different approach. If it was always going to be a debit within our cash book, so a credit within the bank statement, then we would just say, well, actually, we would like to have some terms here where we agree particular fixed interest rates that you're going to pay us. We move some of this money into a higher interest amount. If it was always going to be a credit on our cash book and a debit on the bank statement, we were always going to owe the bank, Well, we just sort out a loan because we'd have an agreed amount there, and we'd pay a lower interest rate. We'll pay a slightly higher interest rate for this overdraft because of the convenience and the flexibility and risk. And risk to the bank always has to, and risk to any provider of credit, anything in this whole thing, risk always has to have a reward, something that you always have to pay for it. So here we're agreeing an overdraft. We've got this flexible arrangement. This flexibility will cost. They will charge us for it. They will charge us a fee for the overdraft, and they will charge us a fee for the interest. That's on an agreed overdraft. Now let's say we don't agree this. Let's say we don't agree an overdraft, but we just go overdrawn anyway. Well, what's happened to our risk? Our risk is higher. Our risk is higher than this agreed overdraft, and if there's a higher risk, there's a higher payment. We will have to pay them more. We will pay them more in terms of fees, and we'll pay them more in terms of interest rates. So not agreeing your overdraft, but just creating an overdraft is going to be worse than agreeing your overdraft, because there's going to be higher risk and higher cost. And essentially the bank has you over a bit of a barrel as well there in terms of negotiating, so you're simply going to have to pay. So the first feature that we're going to have of overdraft and treasury management is if we're going to have an overdraft, we're going to agree in advance. So that's the first thing. So we then go into efficient account management on pages 18 and 19, and it's sort of setting out what happens in terms of the features of running a bank account. And I'm going to give you just an overview here. Let's say we've got this series of assets within a business. Right? Whatever the assets are, the buildings, the vans, the stock, the cash that it's holding, all of these assets here, these debit balances on your trial balance, well, they all need an equivalent credit. They're all going to have various people, either people who we owe money to, loans with the banks, overdrafts, and also shareholders as well. And all of those individual people who hold these credits, they all want to be paid a return. They're all going to charge us something for that money. So what we need to do is we need to get all of the lowest amounts of that we're going to pay them. Even the shareholders are not free. They will want a return for their shareholding. They will want what's known as dividends. Actually, shareholders having the highest risk, so they charge the highest return required. So if we can find and efficiently manage our credit balances, all the various credit balances, and get them to be the lowest charge to us, the lowest return that we have to provide to them, then we have a competitive advantage over our competitors. If we don't do that, so our competitors have lower charges to them for their credit balances compared to ourselves, well then they will put us out of business. And so that actually is why this is important, is because this is how the finance department within a firm generates money for the business to operate. And if the finance department does this badly, the business will go bankrupt. If the finance department does it well, then the business has a chance of doing well. But without the finance department doing this correctly, the business does not have a chance to start with. There's no way that any business has ever outrun a poor finance department. So let's get into next one. So it's sort of saying, well, what are the features then of good bank account management really? So, well, I've first given you the one up front there. If we're going to have an overdraft, we're going to agree it up in advance. Okay, so that's the first thing. The second thing is well, it's always better to have the money in our bank account than in somebody else's bank account. So we're going to make our payments sooner rather than later. So if we receive checks in, we're going to pay them in the same day. We're going to try and find and get methods for people to pay us faster. So always go for backs or faster payments over checks, trying to get that money in. And then when we're making payments, we're going to look at the terms that are offered to us, and we're going to make some decisions. And we're not going to pay late, because paying late means that as we've increased our risk charge there, haven't we? So if we pay late, then we have to pay a return for that somehow. But we could pay later, couldn't we? We're always going to look at the terms offered to us, and we're going to pay as late as possible, typically, but we're not going to pay late. Okay, so if we're offered 30 days terms, we're going to take the 30 days. We're not going to pay in day 5 or day 6, we'll pay on day 30. But we're not going to pay on day 60, because there's a charge for paying on day 60 effectively. Now, as you will have seen previously, there might have been some kind of prompt payment discounts as well being offered. So we might have a look at that and see what the charge effectively is of that, what we might gain from that. But essentially, you're going to look at that and look at whether we should pay. We're going to firstly, we're going to pay everything into our bank account, make our payment, get our money into our bank account sooner rather than later. And secondly, we'll pay later, but we won't pay late. Okay. Now, next things then, it goes into, if we're going to decide, we're going to make these decisions, then we're going to have to understand the timings of these various payments, then, aren't we? So first of all, it sort of says that, well, what gets paid on the same day? Well, you've got cash, or we've also got we've got bank drafts, and we've got backs, and we've got faster payments. Credit cards will come into our bank. I'm going to sort of go into the things that go out of our bank accounts first. So this is what's going to go out of our accounts first. So cash, bank drafts, chaps, faster payments, and backs, they're coming out of our bank account first. Credit payments, that some of these credit card payments made to us, they're going to go into our account on the same day. So that's going to be good. But the same day, the deductions from our bank account, that's going to be the cash, the bank draft, and the chaps, and the faster payments. And 1 day later, if we have debit cards are settled a day later. So the debit card payments and the debit card receipts, they're done a day later. Yeah, so we'll have now this is still good. That's good from our point of view. We'll take a customer's thing by debit cards all day long, and that'd be great. Now, what goes later than that? Right. So checks first of all. Checks. Now, what they're going to have then is when somebody's paying by check, they're going to write out their check and they're going to send it to us in the post. And that post is going to take 3 days to arrive because everybody's going to send it second class. So it's going to come through the post, finding its way through us. It's going to go. We've then got some time to process it. It's got to find the finance department first. A great thing would be to send it in, but to send it to somebody in Department X, and then they've got to go and tootle along and open their check and then go and pay it into the finance department. Often, to avoid that, firms will have reception opening the post, and they will sift out all of the checks and send them off to the finance department first beforehand. That's typically what I would have. But still, we've got this time for it to be actually processed, taken along to the bank by the finance department. So it takes time to process as well. Then what happens after that? Well, if you've managed to find the same branch as the issuer, now it's not the same bank, so let's say they're banking with Lloyds and you go along to any old Lloyds branch, it doesn't make a bit of difference if it's not the same branch as the issuer. If it's on the same branch, so they're in, I don't know, the St Albans branch of Barclays, and you go along to the St Albans branch of Barclays, then fine, it will be cleared on the same day. If you go along to the Barclays branch, I don't know, in Hemel Hempstead, then no, it won't clear on the same day. If you go along to a Lloyds bank, it won't clear on the same day. It will clear 3 days after. You've paid it in 3 days after. So if you pay it on the Monday, it will be 3 days after, the Tuesday, Wednesday, Thursday. You pay it on the Tuesday, it will be the Wednesday, Thursday, Friday. 3 days after the day that you pay it in. You've then also as well got the extra bits with checks. Will it bounce? Is there money actually in the account? Because it allows the banks to check whether there's money in the account, whether there's agreed overdrafts or not. They might just send it back. It's not the same as with things like direct debits and what have you. And has the other side been a bit sneaky as well? Have they decided not to sign it? Have they put different figures in the words compared to the actual in the words compared to the numbers? Things what are known as technical errors, and so that they sort of can say that they sent you a check, but they haven't really. They just made a mistake on it to run the time out. Really. So checks will take a lot longer. The best you're going to get is 7 days, probably in reality. Whereas it could even take longer than that. Right, up to 1 month later then, a credit card. Now I'm saying up to one month later because a company will receive a credit card statement a month, some point in the month. So if let's say I receive the statement on the 30th of the month, or let's say the 1st of the month, and I make a payment on credit card on the 2nd of the month, it'll go all the way to the next 1st of the month, and that's when I'll see it on the credit card payment that I've got to then make. So Up to a month later, really, on credit cards. There'll be charges associated with that, and in terms of the transaction fees that are then done to the supplier, and the supplier might charge us for those. Credit cards as well could be charge cards as well. So let's say it's same thing. The credit card allows them to have credit. The charge card has to be paid straight away. So those are our payment methods, and so we've seen these various different timings. So we got on the same day. These are when they're going to be deducted from our bank account. So if we're doing those on the same day, our cash book and our bank statement should line up. They should appear in the same day. One day later, well, they might be different. Our cash book and our bank statement on the day won't be the same. 3 to 10 days, our checks. Well, our bank statement and our cash book are going to start to come apart or be different, really. If we're paying checks in towards the end of the month, let's say, and we get bank statements at the end of the month, our bank statement is going to say one thing, our cash book is going to say something different. And up to 1 month later, well, our credit card and our cash book, they will be different, really. What we've put under our expenses under our credit card, if we post them. We might not. We might actually post them on the actual day on this point when we get the credit card statement. But in terms of credit management, we might have our credit card will give us up to a month's worth of credit. Right. So let's go into our questions then. I think that's the end. Yep. So let's go to our questions. So insert the words debits or credits. So these questions are on page 24. Insert the words debit or credit into the correct boxes to complete the following 2 sentences. A bank calls a positive balance a whatever balance. So a positive balance for us. So what we've got in terms of an asset, our asset balance probably would be a better question. So a bank calls our asset balance a credit balance. So it's stuff that they owe us. So it would be a credit balance there for ourselves. So the bank owes us money. That's their liability, their credit to us. The bank calls a negative, so our liability balance, what we owe them. So we owe them money, so that's an asset for them. So that would be a debit balance. Okay. Hopefully you've sort of seen that there. So these are opposite basic terms. Right. So question number 2. Good practice in bank account management follows certain principles. So click the correct option. All right. So a bank account should be kept in credit whenever possible. Yes, so whenever possible, you should keep your bank account in credit because you could avoid the overdraft charges. That would be a fair tick. A bank account should be kept in debit whenever possible. Well, if you kept it in debit whenever possible, so it was always in debit, you would just take out a loan because it would have more fixed term, lower risk from the bank's point of view, greater certainty in there, so they would charge you less. So that can't be true. So a bank account shouldn't be kept in debit whenever possible. It should be kept in credit wherever possible. You might consider whether it should be kept in a lot of credit wherever possible, or the money should be moved somewhere else. But it should be kept in credit wherever possible. Okay, the following principles apply when paying money into a bank account. Okay, so we're paying money into the bank account. Tick the correct option. Money should be paid in as soon as possible. Well, yeah, money's always better in our bank account than in somebody else's bank account. We're getting, interest on it rather than somebody else getting interest on that thing. So that would be correct. Money should be paid in at the end of the month. No, that shouldn't be correct because that would just simply be we're going to keep all of our checks in our drawer and then we'll go along to the bank once a month. In there because that's when we feel like going for a walk to the bank. Now, this is an important point actually, and I've sort of seen this myself in as I run finance departments, and yeah, I actually check for when my staff members go down and go to the bank, and I sort of see when they're being paid in, and I'll have a look through because actually some of our staff members would like to go and wander down at the end of the month. I've seen that in some finance departments. And they keep the checks in the drawer, and then they go and wander around every so often to the bank, really, when they feel like a walk. That's not really good because obviously that's poor management in terms of our bank balance, but also as well, it's risky having all of that stuff down. Now, checks one thing, but they could get lost. They've been stuffed in a drawer. And then one of them could fall down the back of the filing cabinet. It all gets a bit messy. What happens in terms of cash? And suddenly we've got £10,000 worth of cash sitting in our safe, really, rather than £1,000, we make a very good target for somebody to come along and steal from us. And also as well, there's just a lot of money around, hanging around, that's quite tempting for other people as well. Remember, we go back to our principles in the introduction that I gave you. Professionally skeptical at all times. If you leave yourself with a really big target in there, somebody within your firm, you don't know who, will go and tell somebody else who knows how to do these things how to steal from you. And I will say as well, watching it on CCTV, it's incredibly quick how people go through and remove safes from companies. People do this as a profession, and so you shouldn't really leave a lot of money around, and you should bank it as soon as possible. That's where we are, and that's the answer. Right, okay. The following principle applies when making payments from a bank account. Tick the correct option. The payment should be made as soon as possible. Well, why would we want to pay and have money in somebody else's bank account than in our bank account? So we shouldn't pay it as soon as possible. That would be daft. It should be made. You might want to look at prompt payment discounts. That might be an option in there though, and that might encourage you to pay sooner, but not as soon as possible. The payment should be later rather than earlier. That sounds good, but not too late. That sounds very good. So that one's right. So we should pay later rather than earlier. That keeps the money in our bank account for longer, but not too late. So not either losing out on our prompt payment discount if we think that our prompt payment discount is really good in there though, or not too late going beyond the terms, because going beyond the terms increases the risk, and a risk requires a reward. So we would have to pay for it in the long run. Either in that one, just to let's say we were a big supermarket, and big supermarkets used to get a lot of complaints from farmers that they would pay very late in their terms. They just applied those terms, and farmers just had to take it. And the issue was that they started to put farmers out of business. If you decided, well, actually, look, we're just a really, really big company, it can hit you on two fronts. On the one hand, you can put your suppliers out of business, and that has a cost. And on the other hand, you now have to report it as well within your accounts, so it doesn't look good. So you would pay later on. You look at the terms, pay later rather than earlier, but not too late. Right, different types of bank accounts can take different periods of time before they're deducted from the bank account. In question 5, choose the correct periods: same day, next month, for the different types of payments. Right, debit card. Well, let's go back. We know that that's the next day, so that's next day. Cash. Well, somebody's come along. They've given us a lump of cash in there. So, right now it's deducted from our bank account. So we paid by a debit card. Well, that will be next day. Cash. Well, yeah, we've taken it out of the cash. We take some cash out of the bank. That's come out the same day on our bank statement. Chaps. We made a chaps payment from our bank account. That's coming out on the same day. Credit card. We're going to get the credit card statement in the next month. So that's going to be the next month. Faster payments is the same day. This one is just one way you just need to sort of go through it and know. Right. Okay. A bit of an interesting question, this one. Question 6. Right, a business, Stokes Limited, banks at Lloyd's Bank in Dorchester. Okay. So they're giving you both the bank and the branch. They're giving it you for a reason. At a meeting on Monday, the director of Stokes Limited hands a cheque to the director of another business, Broad Limited, to settle their account. Broad Limited pays its cheque into its Barclays bank account, Dorchester. So the Barclays bank account in there, but it's giving you the same. It's giving you the same town. They're on the same day. Tick the day of the week that the cheque will be deducted from the accounts of Stokes. Right. So it's always going to be after the Monday. So it can't be on the Monday. Right. So have we gone along to the same branch of the same bank and paid it in? No. So it can't be the day after. It can't be the Tuesday. So that's not going to happen there. So it's going to be 3 days after the Monday, because Wednesdays are relevant. So it's going to be Tuesday, Wednesday, Thursday, so it's Thursday. So if you would have gone and paid it on Lloyd's Bank Dorchester, so we paid the Lloyd's Bank Dorchester branch, it would have been on Tuesday. If we paid it at Lloyd's Bank in somewhere else, I don't know, wherever it was near the Dorchester, it would have still been 3 days after. If it would have been Barclays Bank Dorchester or Barclays Bank on the Moon, if they opened up an account there, it would still be 3 days after. So that would be Thursday. And so that is Chapter 2. I hope you enjoyed it. Good luck with your lesson. Thanks for listening.